Hey everyone, and welcome back to A Smarter Way to Retire, the podcast where we help you build a confident and vibrant retirement. I'm Tony Leonardi, your certified financial planner professional from Newtown, Connecticut, and today is Friday, November 7th, 2025. It also happens to be my birthday. And while I'm not a big birthday person, I'd rather give gifts than receive them. There is something about this time of year that always makes me reflect. We're heading into the final stretch of the year. My garden's been closed for weeks. Thanksgiving is just around the corner. We finished up our big family vacation. And if you're like me, you're starting to think, where did 2025 go? But here's what I want you to focus on. We still have almost 8 weeks left in this year, and those 8 weeks represent your last chance to make smart tax moves that could save you thousands of dollars. Today we're talking about year-end tax planning strategies, the actions you can take right now before December 31st that will pay off when you file your return in April. Let me start with some good news about 2025 taxes. The one big beautiful bill, the OBBB, that was passed on July 4th this year, gave us some unexpected presents, tax-wise at least. The standard deduction went up significantly. For 2025, it's now $31,500 for married couples filing jointly and $15,750 for single filers. That's up from the originally projected $30,000 and $15,000. But there's a new bonus deduction for older adults. If you're 65 or older and your income is below certain thresholds, $150,000 for married couples, $75,000 for singles, you get an additional deduction. For 2025, that brings the total to $43,500 for couples and $21,750 for singles. That was in lieu of the no tax on Social Security idea that didn't make it into the bill, so they came up with this workaround in negotiations. Tax brackets stayed the same this year. They start at 10%, then they go to 12, 22, 24, 32, 35, and 37. And those brackets are now permanent. They are not set to expire. And that's great. I hate bills that expire. I'm not even sure why they make laws that expire. We're dealing with that right now with the Obamacare subsidies, which are expiring at the end of this year and is causing quite a bit of pain in Washington. They should just pass bills that don't have expiration dates, and that might solve a lot of our problems in Washington. I know why they do it. It's a negotiation tactic, but boy, I just don't like tax bills that expire. Anyway, these tax rates are permanent, and that means until someone else down the road decides to change them. So as permanent as you can get in Washington. But here's the thing, just because tax rates are stable right now, it doesn't mean that you should be passive. Year-end tax planning is about working within the rules to minimize what you owe. No one should be volunteering to pay more in taxes than they owe. But to get there does take some work, unfortunately. We know how complicated our tax code can be, and the more you understand it, the better off you'll be in the long run. So let's start with one of the most powerful strategies called tax loss harvesting. I've talked about this in past episodes because it's a great idea. The S&P 500 is sitting near all-time highs right now, around 6,000, but not every investment in your portfolio has been a winner this year. I think that's safe to say. Some stocks or funds could be down. And here's your opportunity. You can sell those losing investments before December 31st and use those losses to offset your gains. You can offset up to $3,000 of ordinary income if your losses exceed your gains. Not too shabby. Any losses beyond that, well, you can carry them forward into future tax years. I had a client, let's call him Mike, who sold some tech stocks earlier this year for a $40,000 gain. He was looking at a $6,000 tax bill, which is 15% long-term capital gains rate. But when we reviewed his portfolio in October, we found several positions that were down. We were able to harvest $40,000 in losses in those positions, which completely offset his gains. So he has zero capital gains tax now for 2025. That's a pretty easy and common example of tax loss harvesting, using your losses to offset your gains. But here's the catch. It's called the wash sale rule. You can't sell a security at a loss and then buy back that same or a substantially identical security within 30 days. If you do, the IRS disallows the loss. So you have to be pretty careful here when doing tax loss harvesting. But here's something that you may not have heard of before, and this is important. You can sell one S&P 500 index fund and immediately buy back a different S&P 500 index fund, maybe from a different provider. Maybe you want to sell your American funds S&P 500 index fund and immediately buy back a Vanguard S&P 500 index fund. What? Really? That doesn't seem right. Well, yes, it's true. S&P 500 index funds are not considered substantially identical. I'm not sure how, but that's according to the IRS. So you get to stay invested while capturing the tax loss if you find yourself in that position. Isn't that wild? The wash sale rule is IRC section 1091. It disallows a loss if you sell a security at a loss and buy a substantially identical security within 30 days before or after the sale. But the IRS has never ruled that two different S&P 500 index funds from different providers or with different structures are substantially identical, even if they track the same index. Wild stuff. I don't know that you'll have losses in your S&P 500 funds this year, but that's an idea to keep in your back pocket, maybe for next year. So here's your action item. Review your taxable brokerage accounts now. Identify positions with losses. Decide if you want to harvest those losses before December 31st. And as always, talk to your CFP and or your CPA for guidance. Next, let's talk about Roth conversions, another topic that's very popular on this podcast. And November is actually the perfect time to think about this. Here's why. Most of the year has passed us by, 10 months have passed, and you now have a pretty good idea of what your income will be in 2025. Your W-2 is largely set. You know what bonuses you're going to get. Your investment income is mostly determined. So you can calculate pretty accurately how much room you'll have left in your current tax bracket before you jump into the next one. Let me give you an example. Say you're married filing jointly with $150,000 of income. After the $31,500 standard deduction, your taxable income is $118,500. That puts you solidly in the 22% bracket, which goes all the way up to $206,700. So you actually have $88,200 worth of space left in that bracket before you move into the next bracket. If you convert $88,200 from your traditional IRA to a Roth IRA, you will pay 22% tax on it, about $19,404. But here's what you've accomplished. That money now grows tax-free forever. No RMDs, no taxes in retirement. And when you pass it on to your kids, they inherit it tax-free. Pretty good deal. Compare that to waiting. If you don't convert and those RMDs push you into the 32% bracket, let's say, at some point down the road, you'll be paying an extra 10% in taxes. On that $88,200, that's an extra $8,820 in taxes. But here's where I want to be clear about this, and this is something that my compliance department takes very seriously. Roth conversions aren't simple. The IRS has something called aggregation rules. If you have multiple traditional IRAs with both pre-tax and after-tax contributions in them, you can't cherry pick which dollars to convert. And then there's the pro rata rule, which means every conversion includes a proportionate share of taxable and non-taxable money. So you have to be very careful when doing Roth conversions. And conversions are irrevocable. Once you do it, you can't take it back. You can't undo it. So if the market tanks after your conversion, or your circumstances change, or you change your mind, you're stuck with it. So this is not a DIY project. You want to work with your CFP or your CPA to model out different scenarios for you to make sure a conversion makes sense for you, for your specific situation, accounting for all the rules before you pull the trigger on this particular strategy. Again, this is also where having a good financial model makes a lot of sense. With a model, you can see which tax bracket you're going to be in today and project out into the future which tax bracket you may be in later on in life. No predictive models are perfect, but you want to make an educated, informed decision when it comes to Roth conversions, and a good financial model will certainly help. So here's your action item for the last 8 weeks. Calculate your 2025 income now. Determine how much room you have in your current bracket. Model a Roth conversion before year end. If you need some help with any of this, let me know. I'd be happy to help. Let's talk about giving. It's not just because it's the season for it, but because the tax rules around charitable giving changed significantly this year. The One Big Beautiful Bill limited itemized charitable deductions. Now, only amounts that exceed 0.5% of your income are deductible. So if you make $200,000, only donations above $1,000 count. This makes qualified charitable distributions even more valuable. If you're 70 and a half or older, you can donate up to $108,000 directly from your IRA to charity. It doesn't count as income. It satisfies your required minimum distributions, your RMDs, if you're over 73, and you don't need to itemize in order to benefit. But there are 2 other strategies worth considering before December 31st. The first is bunching donations. Instead of giving $10,000, for example, each year for 5 years, let's say to your church or your university, give $50,000 all in 1 year. This can push you up over the standard deduction threshold and make itemizing worthwhile. Then you can take the standard deduction the other 4 years. Great idea, bunching of deductions. How about donor-advised funds? Have you heard of these? Contribute a large amount to a donor-advised fund this year. You'll get the full tax deduction now, and then you can distribute grants to charities over the next several years. You get the tax benefit immediately, but you can spread your giving out over time. I had a couple who sold their business last year and had a big tax year. They contributed $250,000 to a donor-advised fund in December, which reduced their 2024 tax bill by about $90,000. Now they're distributing significant amounts every year to their favorite charities. They got their tax benefit when they needed it most in the year of the business sale, and they still get to support their favorite charities for many years to come. Obviously, donor-advised funds are more complicated and have more rules than we have time to cover here today. But if this is something that may be of interest to you, let me know. Here's your action item. Review your charitable giving plans. If you're over 70 and a half, consider qualified charitable distributions, QCDs. If you have a high income year, consider bunching deductions or a donor-advised fund. And again, let me know if you need any help. Here's a strategy most people miss. Gains bracket management. Long-term capital gains rates are 0%, 15%, or 20%, depending on your income. For 2025, married couples filing jointly pay 0% on long-term capital gains if their taxable income is below $96,700. They jump up to 15% above $96,701, all the way up to $600,050. And over $600,050, you go to 20% capital gains rates. Single filers pay 0 up to $48,350, then 15% up to 15% up to $533,400, 20% over that. Most people think capital gains tax is a flat 15%, but that's not true. So if you're retired and living off savings, you might have a low ordinary income this year. That creates an opportunity to harvest capital gains at a 0% rate. Let me give you a real life example. I have a retired couple with $70,000 of income, mostly Social Security and a small pension. After the $31,500 standard deduction, their taxable income is $38,500. They're solidly in the 0% capital gains bracket and have a lot of room, $58,000 plus, before they hit that $96,700 level. They have a taxable brokerage account with $200,000 of highly appreciated stock, cost basis of $50,000, current value $200,000. If they sell $58,200 worth of that highly appreciated stock, they will pay zero capital gains tax. They can then buy back that stock right away if they want, resetting their cost basis higher. This is called gain harvesting, and it's completely legal and very powerful. Why does this matter? Well, because when they eventually need to sell more, they'll have a higher cost basis, which means lower taxable gains in the future. Here's your action item on this concept. Calculate your 2025 taxable income. If you're in the 0% capital gains bracket, consider harvesting some of your gains in your taxable accounts before year end to reset your cost basis. Great idea. How about a few more year-end moves? So as 2025 winds down, here are some quick hits for the final 8 weeks of the year. Max out your retirement contributions. You can contribute $23,500 to a 401k in 2025, plus an additional $7,500 catch-up if you're 50 or older. If you're 60 to 63, the catch-up increases to $11,250 under Secure 2.0. Every dollar reduces your taxable income. HSA contributions, health savings accounts. If you have a high deductible health plan, you can contribute $4,300 for self-only coverage or $8,550 for family in 2025. These are triple tax-free. Deductible going in, growing tax-free, and withdrawals for medical expenses are tax-free. HSAs, health savings accounts. Next, review your withholdings. If you owe money every April, adjust your W-4 now for 2026. If you're getting huge refunds, you're giving the IRS an interest-free loan. Dial it in. Fourth quarter estimated taxes are due January 15th, 2026, but if you make the payment in December, it counts for this year. Use your FSA, flexible spending accounts, because they are use it or lose it accounts. The maximum rollover for 2025 is $660. Anything above that disappears. Schedule that eye exam, buy some glasses, stock up on prescriptions. So as I reflect on another year and another birthday, here's what I've learned both personally and professionally. Time is the one resource we can't get back, and as we all know, time flies by very quickly. But we can make the most of the time that we have. We still have 8 weeks left in 2025, 8 weeks to make moves that could save you thousands in taxes if done properly. Don't let December 31st sneak up on you. Book a year-end tax planning session at leonardifamilywealthcare.com/assessment. We'll review your specific situation and identify opportunities before time runs out. And if you haven't yet, pick up a copy of my book, A Smarter Way to Retire, 10 Steps Towards a Confident Financial Future. Follow us on Instagram at Tony Leonardi CFP and on Facebook at Leonardi Family Wealth Care. Subscribe on Spotify, Apple Podcasts, or YouTube. And please leave a review. Thanks for spending part of my birthday with me. Plan smart, retire happy, and make the most of these final 8 weeks of 2025. We'll see you next week.
Securities and investment advisory services offered through Osaic Wealth, Inc., member FINRA SIPC. Osaic Wealth is separately owned, and other entities and/or marketing names, products, or services referenced here are independent of Osaic Wealth. The opinions expressed herein are for general information only and is not necessarily the opinions of Osaic Wealth or its representatives. Investing is subject to risk, including loss of principal invested. Past performance is not a guarantee of future results. No strategy can assure a profit nor protect against loss. It is not intended to provide specific advice or recommendations for any individual. Please consult your financial professional, attorney, or tax advisor with regard to your individual situation.